In this video, I'll discuss the possibility that index funds may destroy the stock market as we know it. Hey guys, Elliot here. So this is a bit of an unusual video. I like to occasionally dive into financial topics that few others are talking about but yet are still relevant and interesting. For this go around, I picked index funds and the remote but plausible possibility that their popularity could, no joke, bring down the modern stock market. How so? Well, stick around, and if you enjoyed this video, please do consider subscribing to the channel so I can keep bringing you this one-of-a-kind financial content. Now first off, what is an index fund? They are just a mutual fund or ETF that replicates a well-known stock market index, typically the S&P 500. Replicates means it contains the same stocks and in the same proportion as the index. When you buy shares of an S&P 500 index fund, you're essentially investing in the total market, which is more or less the opposite of picking a few select stocks to invest in. The advantage for you, the investor, is that it's easy and cheap. You only need to worry about one fund, and the fees are rock bottom low as it's all automated and no expensive manager is picking any stocks. And as far as performance, well, you won't beat the market, but that's good enough to give historic returns of roughly 10% per year. In fact, 80 to 90% of expensive managed mutual funds never end up beating the market and typically underperform, making index funds look pretty good in comparison. For all these reasons, index funds are a popular choice for just about every 401k out there. Millions of people also invest in index funds outside of retirement plans, and most financial advisors, including myself, recommend an S&P 500 index fund as the backbone of an investment portfolio. As a result of their popularity, index funds grew at an astounding rate in the last 20-25 years and now control about 30% of all assets being invested in the US, which works out to about $8.5 trillion. They are the ultimate form of the passive strategy, and some would say they brought about the democratization of investing. The average person no longer needed some Wall Street insider with their high fees to help them invest, and along with the rise of online discount brokers, the do-it-yourself approach became the norm. Who is responsible for starting all this? Well, mostly this guy. John Bogle founded Vanguard and its first index fund, the Vanguard 500, back in 1976. It was a slow start and the managed fund industry mocked the idea, but with their low fees and steady approach, index funds won the arms race and are now valued on par with managed funds, which is rather incredible. But is there a dark side to all this? The short answer is yes, potentially. And the reasons why are a fascinating study of how the financial markets work and something well worth learning about. You see, the fundamental premise of the stock market is right there in the name, market. We sometimes forget that it is exactly that, a free market. No one is forced to buy your shares of stock at a certain price or even buy it at all. Neither are you forced to sell anything. When you buy and sell shares quickly and smoothly through discount brokers, it's because chances are someone really wants to buy your shares or sell it to you if you're the buyer. That is to say, most shares are liquid in nature and are bought and sold quickly and easily. But just try to sell a thinly traded and unpopular stock and you'll find out quick that you're in a real market. No one may want to buy it or buy it at the price you're selling, and it may be in your sales queue for a long time. Now, because it's a market, someone has to set and modify prices for the shares being traded. So who does this, and why is price so relevant to this conversation? Well, the process of setting prices is called price discovery and is done by what are called market makers. These people and institutions can be brokers, dealers, fund managers, and other active participants in the stock market. They research all relevant factors and set price indirectly by offering to buy and sell shares at certain prices that they deem fair. This consensus behavior, when multiplied many times over, is exactly what creates the price that you pay when you buy or sell stocks, and in fact, publicly traded companies rely on competing valuations to drive price movement. Now, wait a minute, you may say. Aren't stock prices set by analysis and valuation of the various companies and their products, reputation management, competitive advantages, etc., etc.? Well, no, that is value, not price. Price is set by market forces, including supply and demand, with the market makers I was just referring to in the middle of that mix. None of this should be surprising. Have you heard the expression that people often know the price of everything and the value of nothing? It's been attributed to Warren Buffett, and the point here is that value and price is not exactly the same thing, and investors often exploit this by buying securities at a discount, where the price is lower than the value. So at this point, it should be clear that active traders and other market makers, as well as the process of price price discovery is quite important to a well-functioning stock market. How this is all tied together with index funds? Well, if you recall from a few minutes ago, index funds are passive, not active. They don't involve market makers or any traders or managers. They just buy stocks and occasionally sell them, and that's it. Index funds don't do price discovery, and they don't do any research to determine fair market value for any security. As such, they aren't really market participants, but sort of these giant ride-along entities. And this is really the crux of the matter. You need market participants to essentially run the market, and if you have too many passive participants, such as index funds, who are essentially financial freeloaders, well, then you may have some problems. These problems can include difficulty setting prices for securities, especially if there's an IPO, and even a complete freeze of the equities markets where nothing is being bought or sold and pricing can't be determined. Now, while economists and stock market experts agree that something like this may happen if index funds take over, there's little agreement on when exactly this would happen. Right now, index funds comprise about 30% of the equities market and are expected to hit 50% within the next 10 years. Will something happen at that point? Probably not, but what about 70% or 90 or 100? No one really knows for certain what percent of the market index funds need to be at to create problems, but most experts converge on 70% before we start to notice price stability. It's important to note at this point, however, that it's very unlikely that index funds would ever get up to that level or higher. First off, there may well be legislation that limits their growth, but even without any intervention, there will still be many investors who will try to beat the market and stick with managed funds, as well as those who will avoid funds altogether and pick their own stocks. Finance experts say that you would literally have to outlaw managed funds to create an opportunity for index funds to exceed 70 or 75% of the market. And as much as those high fees may annoy you, managed funds are not getting outlawed anytime soon. There are, of course, a few other concerns with index funds that have nothing to do with them not participating in the market. It alarms some market experts to see so much money and power concentrated in what is just a few companies, such as Vanguard, Fidelity, BlackRock, and Blackstone. These funds also pump money disproportionately into the top capitalized companies, and this is why you see Microsoft, Apple, Nvidia, and Amazon taking up such a large percentage of the S&P 500. In the end, though, this is all rather academic, and there's no practical downside for the average investor. Investors continue to pay lower and lower management costs, see greater stability of value, and index funds continue to be highly recommended. Someday, though, this may all change. If you enjoyed this video, please do subscribe, and I will see you all in the next one.